Stage 3 is officially in motion, and it's time to take a good look at 3,000 years of financial history. We've seen 3 global reserve currencies, and guess what? Every single one of them has collapsed after going through the same 4-stage cycle. Right now, the dollar just hit a 5-week low, while silver has doubled this year. What's happening at this very moment is played out before in history. Think Rome, Spain, and Britain. They all follow this pattern, and in stage 4, it leads to total collapse. Stick with me as we decode how this all ends. Here's something nobody's telling you about the dollar hitting 98.96. It's not just a number, it's a flashing red alarm. We've entered the danger zone of a pattern that has wiped out every reserve currency in history. Silver's sitting at $58.62, which is an 84% gain in just 11 months, while the dollar is down 7% year to date and has declined for 9 straight sessions. You really think this is just market volatility? Let me show you something. There's a pattern, a 4-stage systemic cycle that has played out over 3 millennia. Stage 1 is all about setup and foundation. Stage 2 is expansion and debasement. Stage 3, that's where we are now, crisis and loss of control. And stage 4, that's the inevitable outcome. Here's the kicker. We're deep into stage 3 right now. By the end of this video, you'll see why the silver breakout isn't just a bull market, it's a warning. You'll know exactly what stage 4 looks like when it hits. But first, let's break down how this mechanism works. Every reserve currency starts off similarly. Stage 1 is when a nation shines through real production, industry, and wealth creation. They make stuff, export stuff, and their currency gains trust because it's backed by actual value. Think of Rome with its engineering, Spain with its fleets, Britain with its factories, and America with its post-war manufacturing prowess. That's the solid foundation. Then comes stage 2, where things start to get dicey. The dominant nation realizes something seductive. They can print money, and the world will still accept it. Why? Because their currency is woven into global trade. Everyone's holding on to it, and there's no alternative. So they start spending beyond their means. Wars, empires, social programs, and deficits pile up year after year. But here's the trap. The consequences are delayed and hidden. The world keeps accepting the currency, even as it gets debased. This stage feels like prosperity, like success, but it's a slow poison working through the system. And then we hit stage 3. This is where we are right now. This is where the math catches up and reality kicks in. The deficits become unsustainable, the debt becomes unpayable, and the money printing ramps up to cover obligations that can't be met anymore. That's when the critical moment hits. Other nations start to notice. They diversify, they dump the reserve currency, and the velocity of money shifts. What was once slow debasement turns into rapid devaluation. Central banks try to intervene, rate cuts, more printing, promises of stability, but every move makes it worse because the problem isn't technical. It's systemic. The trust is breaking and the foundation is cracking. That brings us to stage 4, total currency collapse or severe devaluation. Wealth evaporates for those holding paper. It concentrates in those holding real assets. Reserve status ends and global power shifts. Here's the scary part. Stage 4 happens fast, months, not years. Once confidence breaks and the feedback loop starts, there's no stopping it. Now, I know what you're thinking. And this is just theory, right? Just historical pattern matching? Let me show you 3 times this exact pattern has played out with mathematical precision. Rome from the 2nd to 5th century, Spain from the 16th to 17th century, and Britain from the 19th to 20th century. Same pattern, same outcome every time. Watch how perfectly they follow these 4 stages. Let's kick things off with the Romans. What happened to the denarius in 300 AD is happening to the dollar right now. Stage 1, Rome dominates. The denarius is 95% pure silver. Everyone trusts it. Everyone uses it. Real value, real trust. Then we hit stage 2, expansion. Military campaigns cost more than the empire produces, so they start debasing the denarius. It goes from 95% to 90%, then 80%, then down to 50%. Each emperor debases a little more, and each generation accepts a little less value, but trade continues because there's no alternative. By stage 3, we're looking at a denarius with just 5% silver. A measure of wheat that cost half a denarius in 200 AD now costs 200 denarii by 300 AD, 400 times inflation. Workers demand payment in goods, and soldiers refuse to fight for worthless coins. The feedback loop kicks in. Emperors print more coins to pay the army, leading to more coins, more inflation, and more crisis. Stage 4 rolls around in 476 AD, and Rome falls. The denarius collapses, and Europe plunges into 3 centuries of barter economy. The reserve currency of the ancient world? Gone. That's the pattern. If that just clicked for you and you're seeing the connections, hit subscribe. Because what I am about to share about Spain and Britain is going to blow your mind. Now, let's talk about Spain in the 16th century. They discover the New World and mountains of gold and silver flood into Seville. The Spanish real becomes the global reserve currency, and Spain is the superpower, the empire where the sun never sets. But here's the catch. They produce nothing. They import everything, all bought with New World silver. The money flows out faster than it flows in. By the 17th century, Spanish inflation is through the roof. Prices in Castile jump 400% in just 1 century. The silver mines start to decline, while other European nations build productive economies. Spain hits a crisis, devalues multiple times, and defaults on debts. 7 defaults in 70 years. By the mid to 17th century, the real is worthless outside Spanish territories, and Amsterdam and London become the new financial hubs. Spain's golden age? Over. Same pattern, different century. Now, let's jump to Britain in the 19th century. They were the first to industrialize and dominated global manufacturing. The pound sterling, backed by gold, became the global reserve. Trust was absolute and stability was assumed. But then came World War I. Britain financed the war through massive borrowing, suspended the gold standard, and printed money. The national debt skyrocketed from £650 million in 1914 to £7.4 billion by 1919, a tenfold increase in just 5 years. They tried to return to the gold standard at pre-war parity, but the money supply had expanded and the debt was crushing. Meanwhile, America emerged as the real industrial power. By 1931, Britain abandoned the gold standard, and the pound devalued by 25% overnight. Other nations panicked and dumped pounds, leading to the collapse of the sterling bloc. World War II finished the job, and by 1945, Britain was bankrupt and dependent on America. Stage 4? The Bretton Woods Agreement of 1944 made it official. The US dollar became the world reserve currency, and the pound that once ruled the world became just another currency. Same pattern every single time. Do you see it yet? Here's where it gets real. The dollar is following this exact same pattern, stage by stage, and we're deep into stage 3 right now. Let me break it down for you. Stage 1. Post-World War II, America dominated global production. 50% of world GDP, massive industrial capacity, real manufacturing. The dollar became the reserve currency, backed by gold, convertible at $35 per ounce. Trust was absolute. The world needed dollars for oil, trade, everything. Then came stage 2 in 1971 when Nixon closed the gold window. No more convertibility. The dollar became pure fiat, backed by nothing but trust and military power. America began spending beyond its means. Vietnam War, Great Society programs, military bases in 130 countries, endless deficit spending. The national debt grew from $370 billion in 1970 to a staggering $36 trillion by 2025. The money supply? M2 exploded from $600 billion in 1971 to $21 trillion today, a 35-fold increase. But the world kept accepting dollars. Why? Because oil is priced in dollars and global trade is dollar-based. There's no alternative yet. So the Fed keeps printing and printing. The imbalance grows, America consumes, the world produces. We've been in stage 2 for 54 years. But now we're in stage 3. Here's where the math becomes unavoidable. Look at the numbers. Really look at them. $36 trillion in national debt, $135 trillion in unfunded liabilities, Social Security, Medicare, Medicaid, pensions. These aren't just abstract figures. They're obligations that can't be met through taxation or economic growth alone. The equation doesn't balance. So what does the Fed do? They cut rates from 5%, potentially down below 4%, inject liquidity, and try to stabilize the system. But something fundamental has shifted. Other nations aren't just watching anymore, they're acting. China reduced U.S. Treasury holdings from $1.3 trillion in 2013 to $780 billion in 2025. Russia dumped almost all its dollar reserves years ago. Saudi Arabia is accepting yuan for oil sales. The BRICS nations are building alternative payment,